Well, hello and a very warm welcome to this session on the outlook for European banking, brought to you by Scope Ratings. My name is Keith Mullin, and it's my pleasure to be your moderator for today. I'm delighted to be joined by Marco Troiano, who's head of Scope's Financial Institutions team. In a moment, Marco will offer his perspectives in a short presentation on the first half of the year and outline the key themes as he sees them in European banking. Among them, profitability and capital, asset quality, bearing in mind we are in a relatively challenging economic environment with rising rates, faltering house prices, and exposure to commercial real estate. Once Marco's finished his opening remarks, we'll move to a Q&A session. We'll be happy to address your questions, so please do type these into the questions box on the platform as we go along. So that's it from me. The presentation that Marco is going to be presenting will actually be downloadable at the end of the session, and so I'll explain how to do that as we go along as well. So that's it from me. Marco, great to see you as always. You have the floor.
Thank you, Keith, and thanks to everyone who joined us today for this half an hour presentation. I thought it was a good idea to basically sum up our views just before going on holiday. I think many people are in our same position, but some things have happened in the first half of the year, and we thought it would be a good idea to refresh our stance. So to start, a quick overview of where we stand in terms of ratings and outlook. Our coverage is very peculiar. We rate all the large banks in the Eurozone, in the UK and in the Nordics. So you're not surprised to see a lot of rating clustered in the A category and AA category. Very few in the non-investment grade. Again, this is a skew which is driven by the nature of our coverage. I want to highlight that we have stable outlooks on over 90% of our ratings at the moment. At the beginning of the year, we published an outlook titled Solid Ships in Turbulent Waters, highlighting the elements of stability in the credit profiles of the banks we rate. And I must say that they've remained pretty much in line with what our expectations were at the beginning of the year. On the macro side, something has changed. I will highlight very quickly the environment we are facing. The first thing worth mentioning is that we are seeing a lot more negative surprises on the macroeconomic side in this Q2. The environment is clearly weakening. For the first part of the year, we managed to avoid the recession by and large, mostly thanks to element of resilience in the European economies, savings and consumptions mostly. But we also found that inflation is a lot more stubborn than most people had anticipated. And as a consequence, the monetary policy tightening cycle is proving to be deeper and longer than expected. We might be getting to the end of it. We're probably going to see another rate hike tomorrow and some possibility of a final one in September. But I think with the most recent data releases, we are probably at the point where the central bank will pause for breath. And we've had a few technical recessions in a number of countries in Europe, but these have been exceptions rather than rule, the main one, of course, being Germany. What do we expect at the moment? Our public finance team has very recently published an update to their economic and sovereign outlook. We're looking at a 1% growth for 2023 and 1.5% for 2024. This is effectively a soft landing. I've put here a few data points again on inflation surprises. You can see for the euro area, inflation has been surprising to the upside for the entire 2022 and the first part of 2023. But by now, I think inflation is more or less coming in line with expectations. And this actually tells me that we can build confidence in our view that the cycle with respect to rate rises is close to an end. This is also what the future market is anticipating, at least in the euro area. Financial conditions remain tight. These are proprietary financial condition index developed by my colleague Dirk Brandenburg. Of course, it's driven by markets as well as policy rates and asset prices. On the market side, you can see that there was a peak around March. This was linked to the US mid-sized bank crisis plus Credit Suisse, but since then markets have come in a little bit. I believe that there is still quite a bit of tightening to come from the normalization of central banks' balance sheets. This is true globally, but in particular, I've put the ECB balance sheet under the spotlight here. You have the chart showing the evolution of the size of the balance sheet over the past 2 decades. And as you can see, there is still a lot of exceptional programs to unwind. The main ones being TLTRO, the pandemic purchase program in green there, and then the public sector purchase program in light blue on the chart. You can see here the 2 main elements. One is really the asset purchase program and how this has turned to negative net purchases in 2022 and then 2023 even deeper, but there is a lot more to go. And then on the right hand side you can see the TLTRO, which peaked at around 2.25 trillion euros, and about half of that has been repaid to date, mostly thanks to voluntary repayments. We're probably going to see this tail off towards zero by the end of the year. The other element which has surprised us on the downside is the quite sharp evolution of real estate prices in Europe. And we think this actually carries some risks for the banking industry. We'll have a look later in more detail at some of the sectors that are more at risk in the bank's portfolio. But what I'd like to highlight here is that this doesn't seem to be over yet. We have quite a few indications from lending surveys of continuous contraction in demand. You can see the chart on the right hand side. And the same is also true for corporate loans. I think I have another slide there. Here on the right, you can see contracted demand for lending to corporates, which combined with still tightening standards, perhaps not at the same level as we saw them in 2022, but still at quite significant tightening levels, should lead us to volumes actually potentially contracting this year. And this is quite a sea change from the trends observed in the past decade of ever-increasing volumes. Actually, is going to turn for sure into a headwind for profitability. Perhaps not enough to upset the positive overall trend in revenues, but definitely slowing it down. When we look at the banks, we continue to see very strong performance on P&L. I think the most important driver by far is the repricing of the balance sheet. This has also shown a few surprises. I think everyone was pretty much anticipating continued repricing on the asset side. We had already seen at least two quarters of it in 2022. It continued in 2023. And at least from what we've seen so far from the Q2 results season, this is still quite strong as a trend. What is perhaps surprising is that there doesn't seem to be a parallel repricing of liabilities. The pass-through rates on deposits remain actually very low, lower than we had anticipated, and this is really driving an expansion in revenues and in profits at the majority of banks. If we look at profitability as the first line of defense that banks have against deterioration in credit risk, we actually take a lot of comfort from the picture you have here on the left-hand side. In every country in Europe, there is a very significant buffer, typically over 100 basis points between the pre-provision profitability and the actual current cost of risk, meaning banks can actually take up to 100 basis points of extra provisions compared to the current level before turning in a loss. What do we expect for the rest of the year? Probably we're going to continue to see expansion in the net interest margin, and this is because, of course, we're not done yet on the interest rate hike cycle, at least for a few months more. And then gradually we would expect liabilities to start catching up, which means we might be seeing the peak of net interest margin expansion in either Q2 or maximum Q3 this year. And then in parallel, we'll probably see banks starting to take more credit provisions in anticipation of deterioration of the asset quality profile. I put a slide here just to show a picture of where we are in terms of asset quality. On the left-hand side, you have the stage 3 ratios. It's really nothing to see. Stage 3 ratios are 2% or below, essentially for on average for every country. There are a few outliers here and there, but this is really a level that we don't see as problematic. On the right-hand side, you see a scatter plot of stage 2 levels and stage 2 coverage. And here, actually, there is a lot more dispersion, both between countries and within countries. And in particular, we see that the stage 2 ratio has gone up for a number of subsectors, in particular, the ones that were already made more vulnerable by the COVID pandemic. And we do think that towards the end of the year, we will see more transitions into stage 3, and therefore a need to provision against those. Our ratings are typically supported by banks' capital positions. Capital ratios, whether you look at them at the CET1 level or at Tier 1 or total capital level, are actually very comfortably above requirements, as well as well ahead of where they have been for the past 10 years. It is not unusual to find minimum buffer to requirements of 300, 400, 500 basis points, which is a level we consider comfortable. And this is an element that supports our rating. We also note that banks are very committed to shareholders' remuneration, and that they keep essentially delivering and promising and delivering any excess profitability to be returned to shareholders. Of course, as a rating agency, we would like to see more earnings retention, but we also understand that given the level of buffers, it's a reasonable assumption that in the absence of risk-weighted asset growth or lending growth, that the excess earnings are actually returned. One comment on the crisis of liquidity in the US. We've published a number of research pieces and commentaries in the first quarter and second quarter, highlighting how we don't see any direct read across from the US regional bank and, in fact, from the Credit Suisse crisis. We have highlighted the differences in the regulation and supervision of funding and liquidity and interest rate risk in Europe compared to the US, and the peculiarity of the Credit Suisse business model with respect to the quality and composition of the funding structure. You can see on the right-hand side of this slide how customer deposits typically represent more than half of the total funding for European banks. And you can also see how a large proportion of customer deposits are considered to be stable deposits in Europe. And you can also see how Switzerland is really an outlier there due to the business model of the two large banks there, now one very large bank. Again, here you see the same information, but I've decided to put a few names of banks, and this is really to show you how the composition of deposits is a direct consequence of the business model. So on the left-hand side, you see banks which are more retail-oriented, pure commercial banks typically. And then on the right-hand side, you see more the private banks / corporate banks types, Deutsche, SEB, UBS being +3. And you can see that the amount of retail stable deposit is really a minority there. A few words on asset quality. On the left-hand side, you have data from ECB supervision showing the decline of NPLs over, I think it's the past 5 years. I mentioned before there is nothing to see yet, but at the same time, we cannot ignore what is going on in terms of affordability of current stock of debt. So on the right-hand side, we put as an example the average cost of borrowing for households and corporations in the Eurozone. You can see the increase is more than threefold for corporations, for example. This is bound to bring about some deterioration in the credit quality and is an element that we cannot ignore. So we keep our eyes very focused on the even early signals of deterioration in different segments of the credit market. This is one of the things we look at is whether there are early signs of deterioration in the stage 2. You have an upwards trend since the beginning of COVID, but nothing really traumatic there. What you see on the right-hand side, I think, is more interesting. You can really see that there is an upward slope in several sectors, but for some sectors, this is a lot more pronounced than for others. And I mentioned the sectors which were more strongly affected by COVID. I need to mention the energy crisis as well. You see here transportation and storage actually also being quite steep in the deterioration. One word on commercial real estate. There's a lot of focus on this segment of the credit markets. Of course, it's one of the most cyclical and risky and exposed to the combination, I would say, of factors. So declining real estate prices, increase in financing costs, and overall tightening of lending standards. We do expect this to be a source of risk, but then when we look at it in the context of the overall loan books, this is typically a small proportion. So it can represent actually a majority of the corporate loan book in certain countries like Sweden and Denmark. But then these are countries where the vast majority of the loan books are actually residential mortgages. And if you look at it as a percentage of total loans, we are typically looking at a 10 to 15% max of the total exposure. And here we're taking a very broad definition of CRE, so including both loans to construction and management companies, as well as companies with real estate loans with real estate collateral. My final slide is actually on market access. Especially the chart on the left shows you that both Q1 and Q2 have been extremely strong for bank issuance. Banks have issued a lot of senior unsecured debt as well as covered bonds. Of course, in Q2, there has been a lot of volatility, especially around the AT1 asset class. There's been a period where the market has been essentially closed for AT1s, and it has only recently restarted. In fact, the reason I show this chart is to highlight a key difference between the mini crisis that we've had in March and some of the other crisis episodes that we've seen in the past few years. So if you look, for example, at COVID in 2020, you can see how significant the drop in issuance has been for banks. That reflects a much deeper level of uncertainty in that case, and also much more prolonged. And I don't have on this chart actually the height of the great financial crisis, but the reality is that the market has been actually closed, at least for a number of banks back then. And here, again, this is to highlight the difference in market sentiment with respect to European banks. Yes, they are high beta on the equity side. Yes, there is a lot of speculation. Yes, there has been price action, in particular on AT1s. But gone are the days where actually the market shuts off. I think everyone is a lot more comforted by the implementation of Basel III in Europe, by the banking union, and in particular the single supervision of the sector, as well as the consciousness that we now have a central bank which is ready to act as a lender of last resort to the sector, a role that they've successfully fulfilled several times already in the past decade. I will stop here at 20 minutes, Keith, and I will take questions from the audience if there are any.
Excellent. Thank you very much, Marco, for running through those slides. Some great insights there. I do have some questions. Some are quite specific and some are broad. So I'll start with some broad ones, and then I'll perhaps we'll take a dive into some of the more specific ones. So you kind of covered it, I guess, already, but your expectations for second quarter European bank earnings. Am I right in thinking that your expectation is for more of the same, i.e., similar to Q1? Do you see any major structural changes emerging in Q2 numbers? Sure, they haven't come out yet, but they're imminent.
Yeah, no. In fact, we've had a few banks reporting results already, and the trend looks quite clear. It's a very positive season again. I hinted at that. More of the same on the net interest margin, i.e., more expansion of the net interest margin, and a very positive performance of revenues overall. At the same time, cost inflation doesn't seem to follow the more general inflation pattern. Banks are actually quite successful at containing costs, largely because of management actions that were long in the planning. I mean, this is a sector that suffers from structural overcapacity. So plans to reduce branches, reduce number of employees, and improve efficiencies are always part of strategic actions now, I would say, for at least a decade. So this is counteracting a little bit the pressure on employee wages. And then on the cost of risk side, there is no real deterioration, but we start to see banks taking management overlays to anticipate essentially potential credit problems later on. This was the case, for example, for some of the Swedish banks and the commercial real estate exposures. So I would say my expectation is this: overall, very positive set of results. Perhaps a little bit more caution on the cost of risk side, but not because of an actual visible deterioration, mostly due to post-model adjustments.
Yeah. And just in terms of then the cost of risk that banks have signaled to date, you don't find the increases particularly alarming. They're just as you would expect.
Yes, and we've actually run an exercise at the beginning of the year, stress testing the cost of risk assumptions that we had, and we take a lot of comfort from that exercise. We concluded that the sector can actually take on very harsh downside scenarios. So we ran a number of them. The harsher one was one where net interest margin was actually stable to the end of 2022, and where cost of risk was actually going up threefold, and still only a handful of banks were going into the red and eroding capital, which is actually also quite reassuring ahead of the stress test results that are coming out on Friday. I think we're probably going to see a fairly positive results.
Okay. Very good. Now, you mentioned the net interest margin expansion story coming out of rising interest rates, and you also mentioned that the deposit beta has been less than reassuring for depositors and savers, and your expectation is that will the liability repricing will tick up. Going forward, I mean, what does that look like? So going forward, then, let's say we reach the end of the expansion phase of net interest margins, and they start to shrink at that point. Bearing in mind, we've also got potential corporate refinancing and or default risk, which is also rising, certainly in theory, and we have overextended households as well. Are there any sort of concerns in the back of your mind? Oops, just hit my line. Going forward about how that might translate into earnings and asset quality ratios?
Yeah, I mean, I must say, first thing, I think the slow speed with which deposit pricing has reacted to the interest rate cycle has been very surprising. If you were to ask me 2 years ago, all the banks were complaining about low for long interest rates and how higher interest rates would benefit them. I would have said yes to an extent, but then at the same time, you guys would be under extreme pressure to start remunerating deposits, which have been financially repressed for 10, 15 years. So the real losers from the great financial crisis have been taxed to death, and then have seen their remuneration go to zero and stay at zero for very long. So I'm surprised that there wasn't, more clamoring around the remuneration of deposits. We've seen a little bit of that around banks' excess profitability and, bank profitability taxes being imposed in some countries, or at least discussed in other, like in Italy at the moment. And I think that will continue. So banks will come under pressure to increase remuneration, but probably before they actually come under pressure from their politicians and from a public image point of view, we should start to see competition for deposits eating up a little bit. So in my view, the reason we haven't seen this competition and we haven't seen deposit repricing so far is that the market is still awash with excess liquidity created by the central banks in the wake of COVID. This is coming off. The central bank, the TLTRO is being repaid, the asset purchase program is going into reverse. But in reality, the rate rises are not creating that scarcity in liquidity, and banks don't feel that they need to compete with prices for the deposit basis. My view is that as liquidity gets soaked up by the central bank over the course of the second half and then 2024, we will start to see some tension on liquidity, also in Europe. And that will translate in a bit more competition for deposits, and therefore in a shrinkage of net interest margin. So that's to the first part of your question. The second part is this is going to come probably at the same time where we're going to see the cost of risk going up. So I think if you're looking at profits, we might be seeing the peak. I would be very. 2022 was a fantastic year. 2023 is probably going to be a fantastic year, maybe even better. I would be very surprised if we had a further growth in profitability in 2024.
Okay, we'll see. Thanks for that. You mentioned liquidity. There's a couple of questions on AT1 which I'll come to in a sec. But there's a question about liquidity, which caused liquidity was front of mind early in the year when people were casting aspersions about deposit stickiness and alternatives and etc. There's a question here which I'll read to you, and then perhaps you can see if you can respond. And the question is, can you give us some hints in order to be able to appraise liquidity of banks in addition to LCR, whose limits have been demonstrated?
I think it's a good question. I think the LCR, we need to understand what the LCR are and what they're useful for. So the first comment I would have is the LCR is a very backward-looking measure of liquidity. It shows essentially the liquidity of a bank in the previous 12 months. In fact, in the 12 months previous to the end of period. But when it gets published, it's typically another month is gone. So it tells us absolutely nothing about the forward-looking liquidity of the bank. But it does tell us something about how banks manages the liquidity, and in particular, how it manages the regulatory constraints around liquidity. So I think it's a useful tool. Of course, it's not a holy grail. The other comment I will make is the one thing you can do with LCR is not look at the headline ratio, but look at the composition of the LCR, which you can actually find in the LCR in the Pillar 3 disclosures of banks, and you will be able to gain insight on the structure of the funding, and in particular of the deposit basis of the European banks. I think that can be extremely helpful. And then, of course, you have, when looking at liquidity, you have disclosures from the bank about the size of their liquid portfolios. You have the disclosures surrounding encumbrance, which you can use. I've had this discussion recently with, in a supervisory forum. My answer is that I would actually look at the tension in deposit pricing markets as an indication that liquidity is actually tightening. And exactly for what I was mentioning before. Look at the behavior of banks and the behavior of market actors. That can be a lot faster moving indication of liquidity tensions.
Absolutely. Indeed, Marco, there's a question about AT1s and what are the probabilities of European banks calling their AT1s on the first call date? Now, bearing in mind, some banks have said categorically we'll do it on economic terms only. Others do it as a matter of debt investor relations. So there's different horses for courses. But would you give a general comment about AT1 call probability?
Yes, it's a bit difficult for me to answer. We don't rate call risk on AT1s. I would say the probabilities of AT1s being called on first date is actually still quite high. And the reason is that the definition of what an economic call is still a little bit up in the air, and it's very easy to assume or demonstrate actually that being market friendly in terms of AT1 calls can actually have a positive repercussion on the rest of your capital structure and therefore on the rest of the issuance. I would say that not calling AT1s would still probably be an exception rather than the rule.
Yeah.
Especially given that banks, at this stage have a lot of options. So, at least the major European banks are buying back shares. So you could, buy back and sit out and cancel part of a buyback instead, if you think that the pricing in the market is too expensive.
Indeed. Now, on a related note to you mentioned buybacks, and you mentioned in your introductory comments that you were pretty comfortable actually with banks' capital ratios as they stand at the moment. You also said, as a rating agency, as rating analysts, that you would like capital to remain in the system rather than being returned to shareholders and creditors, etc. What would your kind of steer be to banks at a general level about their sort of capital return policy? Exercise restraint, or are there any sort of red lines for you out there?
Sorry, can you repeat the question?
What would your kind of advice to European banks be around capital return policy, and do you have any red lines?
No, we don't advise banks. It's not our role.
Okay.
My comment is, and of course, coming with the credit hat, is it's okay to be very excited about the current levels of profitability, but as I've mentioned before, we might be, looking at a peak profitability moment, and we know that sooner or later the margins will have to shrink, and we'll have to deal with an asset quality cycle. My base case is that none of this is going to be problematic, and the banks will be able to absorb the losses out of ordinary profitability. But then you need to, hope for the best and plan for the worst. So I think accumulating prudential overlays at a time of peak profit is something that good prudent management of bank is also about, and we see it. I mean, good banks are actually accumulating a provisioning overlay for those area of the loan book where they see a likelihood of problems.
Yeah. Okay, Marco, there's a question I suspect we may have to follow up with, which is so there's a question about do you have a comparative scheme showing which banks in Europe are the most dependent on AT1 among the different bail-inable layers, unless you have that data in your pocket. Perhaps we can follow up.
No, I don't have it from the top of my head, but I can, as a general comment, they're not very dependent on AT1 for bailing. This is one of the smallest actually pockets of liabilities in a bank capital structure. So it's yes, I think the vast majority, the largest stocks are common equity tier 1 and MREL debt securities, so senior non-preferred typically. AT1 and tier 2s are there. I wouldn't say banks are reliant on that, not for MREL, not for capital. I mean, they have an excess, which means they could afford to sit out of the AT1 market for a while.
Yeah, makes sense. So perhaps a big question, this is when you have to get your crystal ball out. What will the ECB stress tests tell us?
My expectation is that it's going to be a no surprise type of exercise. It's been for several years already. So this is not about, banks haven't really failed stress tests for a while. They can't properly fail stress tests. So this is about testing their resilience under an adverse scenario. Now, it's true that the scenario we're using this year for the worst case, the adverse, is a lot harsher than the ones we've seen in the past. So we're looking at around 6% GDP decline over 3 years and 6% increase in unemployment. But it's also true that the starting point being end 2022 is a point where bank balance sheets were in the best shape they've ever been in terms of capitalization, in terms of NPLs, in terms of where their profitability was. So I actually expect banks to perform very well on the basis of a heightened profitability in the stress period, absorbing most of the losses. I look at it more as a source of data and information rather than a source of the next bank to fail or something like that. The one aspect which I'm really looking forward to verify, it's an assumption that I have, is that when the central bank started stress testing banks, there was a very clear divide between core and periphery in the Eurozone, where Greek banks or Italian banks were constantly flagged as the weakest in the continent due to the high level of NPLs and the need to provision. And now that the balance sheets have been cleaned up, I actually expect that situation to be completely reversed, because we might see that these banks are actually the most geared to the interest rate cycle, this is one element I'm actually gonna look for on Friday evening. We've had some leaks to the Spanish press that seem to confirm that Spanish banks were actually performing really well with erosion of 170 to 250, I think on average, 170 for Santander. These are very low numbers for a stress test. So I'll be looking for the other results.
Yeah, absolutely. I think as we all will. So Marco, I have no more questions, and so I suggest we close the session at this point. For those of you who are there, so thanks for watching. Hope you found that useful. You can download Marco's presentation by clicking on the apps button at the bottom and then clicking on the handouts, and you'll see a PDF which you then can download. So while you do that, I wanted to thank you very much, Marco, for the time and for the insights. Always fascinating as usual. I hope everyone found that interesting. We will come back and do these sessions on a fairly regular basis, so look out for our next session. Just an indication, we are going to be coming out with Q2 research notes on Spanish, Italian and French banks post the results season, and so do look out for those on the Scope Ratings website. So that's it from me. I wish you a very successful rest of the afternoon, and thanks for watching, and it's goodbye from us.
Thank you. and good afternoon to everyone.